All right, good morning. Today is Monday, May 3rd, 11 a.m. section. We are in the home stretch for the semester. So as we get started today, just a couple logistics things, and then we'll talk about homework 12 in just a second. But basically, Wednesday will be your final group project on general dynamics. So again, each team will have 10 minutes. We'll go through all 6 teams during the class. So just make sure you turn your file in before class and come prepared. Just to be really clear, because I got a couple of questions about general dynamics and what you need to present in terms of the ratio analysis. So you're going to need to basically have 7 companies in your ratio analysis for general dynamics, which is a process you'll repeat across the 3 ratios. So you have to do it for the PE explanations, you'll have to do it for the EV to EBIT, and then EV to sales. And the companies that you need to do, just to kind of make sure you see this in Bloomberg. So if you were looking at GD US equity and RV, as you remember when we did EIC, they have 3 segments. So here under BIC's best fit algorithm, the first segment is defense, and these are the defense peers. So what you're going to need to do is pick 2 companies on this list. Okay, so I'm not going to tell you which 2 to pick, but pick 2 that you believe are representative, and that's who your peer group should be for defense. Same thing. It's general dynamics against these IT peers. So pick 2 companies that you think are representative of their IT peers off of this list, and then pick 2 companies off the aircraft and parts manufacturing off of this list. Okay. So again, I'm not telling you which 2 you have to do. You can choose. Sorry, stop sharing there. You can choose which 2 in each of the segments, but you will need to essentially find the 2 representative peers in each of those segments. Okay? And then you'll do the multiples on each of those. So when you're making your presentation, it's GD's representation of how they're doing in the aircraft business, GD's representation of how they're doing in the defense business, and the IT services business. Now, just to be clear, if you were to say pick Textron as a company, Textron is somewhat of a conglomerate, and they have multiple business segments as well. But you're not actually, you can't do the segment of a company for multiples. So there's just one company for the multiple. So that's actually a good reason why multiples analysis are difficult. Just another example, say GE, General Electric down here. Right, because GE is, again, an industrial conglomerate. It's got a bunch of different businesses. They're all represented in their multiple. You can't actually break out one of their segments in a multiple. And so usually when you do multiples, that's why you like pure plays, because that is a more representative company than I'm looking at, because that's all they do. But unfortunately, that's more of a fantasy. In today's world, you have these multi-business unit companies. And so essentially you tend to use them as proxies, but it's not always an apple and an orange. It is sometimes a little bit different. In any event, that's what you're going to have to do for GD. Questions about GD?
So when we're presenting, is it best that we break up like the different parts of the presentations by the different sectors that they're in?
Yeah, I mean, if I were you, you could structure it in any way you think is appropriate, but I might say, all right, let's do the aircraft and parts, and we'll do the companies and the 3 multiples. Then let's go to defense and do a company and 3 multiples. Then let's do IT, company and 3 multiples, and just repeat. That might be the easiest way to do it in terms of your presentation. So it's almost like you did 3 mini presentations. But the important thing is you can't just do all at once. You can't just lump them all on one screen. Then it would just be confusing. because they really do have different industries. And you can kind of see that. In fact, I'll go here to our multiple sheet that we had done earlier in the semester for our bear and bull. But notice, like when you look at the aircraft and parts business, these multiples as an industry average are much different than the defense multiples. And that's the point, is that the multiples people are paying are going to be different in the different industries because the industries have different growth spread combinations. And so therefore, if it has a different growth spread industry, then it's going to have a different multiple analysis to begin with. That's part of what you're essentially explaining when you start looking at General Dynamics 3 businesses. Other questions about Wednesday's presentation? Make sure you put all your data in the PowerPoint. You're going to be presenting from the PowerPoint. And again, submit before class. Right? Submitting as a team. 10 minutes plus a question. You guys, you have been through this process before with the other 3 team projects. This is the final team project. All right. The other thing that's due Wednesday is the final Bloomberg trading competition. So very important that you don't liquidate your portfolio, because again, if you have too much cash, you will be disqualified. So here is section 101, second half, and here is the ranking as of today. So again, I'll just take the screenshot at the end of day Wednesday. You don't have to do anything. Everyone's met the minimum 10 long criteria. So basically, this is how you're going to be scored. But the Bloomberg trading competition ends Wednesday night at the end of class. Right. So the other thing that's going to be important for this week is that met with the TAs last week. They're working their best to try and get the grades done as quickly as possible. But essentially, all the grades are going to be put in, with the exception of the final exam, by Thursday night. That's our internal deadline as well. So essentially, you'll have a pretty good idea what your semester grade is on Thursday. And also, I know some of you are probably having to decide whether you want to take the class pass fail. I believe that's still an option that you have until the last day of class. So you can look at that. The other thing is that today is the last day if you're going to do the assignment replacement. So if you're going to do the assignment replacement, make sure you turn that paper in today. Otherwise, you won't be able to do it. Right. So it's your last chance of the assignment replacement. And so for the assignment replacement, that's going to be put in between now and Thursday. The TAs will do it. They'll just replace your assignment. And the way it's going to show up is if you've had an assignment, individual assignment replaced, they'll put under the assignment replacement what assignment was replaced and how many points was being replaced by that, so that they will run through, and they're also checking all the attendance criteria this week. But basically, the final exam opt-out criteria will be applied so that by Thursday night, they'll either put in 10 points for your final exam or they'll leave a 0 on it. Again, if you see 10 points, then you're done. You don't have to take the final exam. The points are added. Those are your final points. You'll know your grade. If at the end of Thursday, we'll make an announcement when this is available to see on Friday. If you don't see a grade for your final exam, you have a 0 next to it, then you will basically take the final exam 1 week from today in class. And that'll be the only outstanding part of your grade. And then how you do on that 10-point final exam will then be a multiple choice exam. So it will be auto scored by ELMS. So essentially, after you finish that exam, it will then be posted. And then you'll see your final points. All right. So very quickly, you should have a pretty good idea of how you're going to end the semester this week. Questions about grades, logistics, what's coming up? And then the final item this week is the peer reviews. So again, if you feel you need to fill out the peer reviews, optional peer reviews are going to be due Thursday. If you don't think you need a peer review, you don't have to fill out the peer reviews. And those will also adjust any group project rates. All right, so let's talk about the final homework assignment, which was homework 12. And that was the multiple assignment on Starbucks, Yum, and McDonald's. So it'd probably be easier if I just share my desktop. Okay, so this would be homework 12. And in section 101, so you save this file. My computer. All right, you'll notice that in my solution here, I don't have the growth and return on equity filled in because the return on equity for this industry is going to give you a challenge. So specifically, if you went to SBUCS, US equity, and you went to EEO, and you went down here and you looked at the forward return on equities, you got negative numbers. So is this acceptable to use in perpetuity? Could we just take an average of these 4 negative numbers and say that's the number we use?
No.
No, why not?
Because it's not realistic that it's going to be negative forever.
Exactly. Like you can't have a negative number into perpetuity forever for a viable business. So therefore, we can't use these negative return on equities, which all 3 companies have, as their return on equities, because that doesn't make sense. So how might we come up with a return on equity for Starbucks?
What I did on mine, and I'm not sure if this is correct, I went back in their historical ROE to a point where they were stable, and then I took an average of those numbers.
Okay, so you could have gone to FA, you could have gone to custom, created a custom, and just said, show me return on common equity historically. If we wanted, we could look back 10 years. Type 10. 10. There we go. All right, so what number did you use approximately? Were you kind of looking at this range? Did somewhere in the
Yes,
40s,
I think
50?
it was around the 30 to 40. I don't have mine pulled up, but I think it was around that range.
Yeah, so if you're in the, I think you can make a case. Obviously, 2013 was an outlier year, but you could make a case that somewhere between the mid 30s and 40s, even as high as 50, but probably 40s, seems like a more reasonable return on equity post-pandemic, given where they were in the past. Okay, so that's one way you could have done it. What's another way you could have done it? If I had ROIC on here, what are these ROICs? This is Bloomberg ROIC. What are they based on again? What is Bloomberg ROIC based on? How do we say it's being calculated?
Don't they have operating and non-operating?
Is this one combined? So even if I right click and do a definition, they define it as return on invested capital, and they actually define invested capital as the total debt and the total equity of the firm. So essentially, this is the return on the debt and equity of the firm. Okay. So can we use a concept of return on debt and equity, the return on the average of the debt and the equity, to basically get a return on the equity? What would we need to know? If this is the average return in debt and equity, and if we knew the capital structure, how much debt versus how much equity, we could work out what the return on equity would need to be. Right? Because the return on invested capital is the average of the return on equity and basically the return on the debt holders. So if we knew what that average debt to equity ratio was, and we knew our return on invested capital, then basically we can get to a return on equity. All right. And so what we really need is the invested capital to equity ratio. Okay. What is the ratio of debt to equity? Right. And that would basically get us a return on equity. Okay. So there's another way that we can kind of proxy this. So for example, Starbucks is 85% equity. He's using it as a market basis, right? So take total capital divided by equity, and the total debt and equity is 100%. The equity is 85%. So 100 divided by 85%. Is that 1.2? Something like that. So basically, take your ROIC, multiply by 1.2, and that's approximately where your return on equity should be. So let's say this another way. If I go back to FA and I'm looking at my ROIC, we looked at ROE. We look at return on equity. Spell today. Sorry, return on invested capital. Then somewhere around, this is, call it 30%, average these years out. 20% of that is in around 40. Okay. And so if we look back here and we went 10 years and we said somewhere around 35 to 40 seems right, and based on their debt to equity ratio, which debt divided by equity is about a ratio of 1.2 on a market basis, then basically take return on invested capital at 20%. We're kind of triangulating to say that range actually looks like something it could be normal. So, pick a number, but somewhere around 40%, give or take, is probably Starbucks. Right? And as we talked about before, whether it's 40 or 45, once you get this high, it's not going to make too much of a difference. But this should have been your rationale along these lines, whether you looked at it historically and you did an average of the historical rates and you got somewhere in the 35 to 40% range, or 45% range, you could use any one of these averages in here, and that would have probably been acceptable, but that would be the point. Or you could have gone a little more sophisticated and you could have figured out their debt to capital ratio. And basically, or in this case, capital to equity ratio, and essentially proxied out based on the return on invested capital, what the return on equity would be given an ROIC. But either way, you would have need to come up with something, because negative return on equity forever doesn't make sense. Because basically what it would mean if you had a negative return on equity, if you had a positive profit, is you'd have to have negative equity forever. And you couldn't have a business that was more than 100% debt finance. Like, it wouldn't mathematically make sense. And at some point, the bondholders would essentially be financing the 100% of the company. And at that point, the bondholders would want to become owners. If I'm financing 100% of the company and the equity holders have no stake in the business, I'm not going to let them take all the profits and I take all the risk. So that's not conceivable. You can't have a business with no equity forever, right? No one would lend them debt. At that point, they might as well be equity. So the point of the story is you can't have that in perpetuity. So you have to come up with, yes, do they have this in the short term? Absolutely. But from a valuation standpoint, we have to come up with a proxy return on equity. And we're going to have to do the same process for the other two firms. That's actually made this assignment a little bit more difficult. Questions? What, why, how I'm doing anything that we're talking about? Now, there would have been another way you could have done this. So I'll give you option 3. Option 3 is you could have actually done a valuation of each of the 3 companies using our model. Because if you built our model, then you would have essentially built an ROIC into the future, and you would have built by proxy an ROE into the future. And then you could have used the model ROIC and the model ROE in these multiples, right? And so I'll give you another proxy of this. We've been saying, PRC, that when we looked up the tax rate of these companies, let's take Starbucks as an example, we were using, here's a JP Morgan report that came out this morning. We've been saying, just using JP Morgan as an example, that we were using it to get a tax rate. But you'll also notice that in the JP Morgan report, they are forecasting ROE. Okay. They're having the same challenges as we are, but they are forecasting ROIC, which they call return on capital employed. So this is ROIC right here, being that's forecasted, because that's the point. You have to forecast out the ROIC to forecast the free cash flow, right? And so there's a forecast. And again, if we had built out our valuation models, we would have a forecast for ROIC as well. And so the idea is that just as we used the tax rate from JP Morgan as a proxy for the long term, because we all have to use a similar tax rate, in a way, we could use their ROIC/ROCE as a proxy for the ROCE, ROIC going forward. Now, this is just a little bit different because their ROIC is closer to the Bloomberg calculation for ROIC, not the Modigliani-Miller calculation for ROIC. But again, for most companies, is it going to make too much of a difference? And so again, ROIC, ROCE, somewhere in the 50% range going forward, infers 1.2 multiple, ROE a little bit above that. So you can make an argument, if we went to JP Morgan, that this number, instead of 40, could be as high as 60. So you can come up with a couple of different ways to do this. And by the way, if we did go down that route, then this ROIC for the future also matters. Because when we go to our RV, custom operating ROIC, and ROIC, we have to decide whether these numbers are representative of perpetuity as well when we do the enterprise value multiples. And the problem is 7% is probably not representative of the perpetuity period for Starbucks, because Starbucks was affected by the pandemic and having their stores closed. So last year, which is really what these operating ROICs and Bloomberg ROICs are about, are probably not representative of what the market is looking at in the future. So again, we either would have had to go back historically to look at what their ROICs are, or we could use something like JP Morgan to give us prospectively what ROICs are going to be. And so again, whichever method we chose, so let's assume we're going here, then we're probably looking at an ROIC not of 7.21%, but of something like 35%. Now I'm syncing this up with this number, about 20% less, ballparking it. It's 34 or something like that. But the point is, I'd have to sync them because this number is related to this number based on capital structure. So I could use the ROEs to drive ROICs. I could use the ROICs to drive ROEs. I could look retrospectively at ROEs or ROICs. I can look at prospectively what people are forecasting for either one, but I have to come up with something that's more representative in order to do my multiple. Then I could solve for my G. Questions? That's what made this a much more difficult assignment. Even though the companies are pretty straightforward, their multiple analysis were harder in homework 12. Because you can't just start out with the returns, because the returns today are not representative of the returns in perpetuity. That's not the way the market is trading these companies. And so there's an extra step trying to understand approximately what are those returns to help you then figure out the growths. So again, back to the PE. If I did this with my goal seat, then I want my PE to be 3267. Changing cell B3. So I should end up with a growth rate approaching 9% for Starbucks. So, questions? All right, we'd be following a similar process for the EV to EBIT. So for this G, we want to get the EV to EBIT here, 2662. So RG. Oh, so. About 7.6% G for Starbucks on the EV to EBIT, and about a 9% G, 8.92 on the PE. Which if you had a negative cost of equity, you would have gotten a really weird growth rate in order to make it match. You probably would have had to have a negative growth. Right? So we would finish up with McDonald's basically in a similar process. If we did McDonald's, say we'd use the historical numbers for McDonald's. Type ROE. Up until 2016, it was in the 30s. So again, high 30s to around 40. It's probably around, I don't know, call it 38, 37. Which means ROIC $20-ish. And so this would get me a G. $5.2%. And then Yum, I actually think if you look back, these numbers probably actually do look more representative. So I don't think I was going to change the Yums. So I think for McDonald's, let's do a little seek for that. And if this is 50.65, switch this to Yum. This is going to be like 70. And then from here, it would just be a combination of premium or discount. And so that would be the point. Like, why is Starbucks trading at a premium to Yum? And to some degree, McDonald's, it's not its growth rate. Yum's growth rate's actually probably perceived to be higher than Starbucks. It's trading at a premium to Yum because of its cost of capital, right? So Yum is being hurt by the 12.5% cost of equity versus the 11.3% cost of equity at Starbucks. And that's why Yum is trading at a PE of 26, while Starbucks is trading at a PE of 33. McDonald's is trading at a premium to, sorry, a slight discount to Yum, as much as you would expect, despite the lower growth rate and lower spread, because again, they have the lowest cost of capital of the three in terms of cost of equity of 9.8 versus 12.5 at Yum. And that's why their PE is actually much better than otherwise would be, despite the fact that they have lower growth and lower spread than Starbucks and Yum. So in this industry, what seems to be driving the PEs more than anything else, because the growths are so high and the spreads are so high, is the predictability. In this case, it's the lower beta, essentially, of McDonald's, which is giving them a lower cost of equity. And that is why their PE is close to Yum. And that is why Starbucks, with a lower cost of equity, is trading at a higher PE than Yum, despite the fact that they have similar growth rates, call it both around 9%, despite the fact that Yum has the higher spread. When you guys did your EV to EBIT analysis, again, their tax rates are pretty close, right? But we see the same thing playing out. Like Starbucks is trading at a premium to both, actually, because they have a higher G, right? And relative to an overall WACC, they have a similar WACC to Yum. So in this case, it's the extra growth at a slightly lower spread, which is getting them the 7.6% versus the 6.6% on an operating basis, on an OPLAT basis, is why Starbucks is trading at a premium over Yum. McDonald's is trading at a premium over Yum in EV to EBIT, 22 versus 28, because McDonald's has the lowest WACC in the industry at 7.8%. So despite the fact that McDonald's has lower growth and a lower spread than Yum and McDonald's, they have a premium in EV to EBIT because of this lower WACC, 7.8 versus 9.9. Although McDonald's is still trading at a discount to Starbucks, Starbucks trading a premium to McDonald's, despite the low WACC, 7.8 versus 9.8, because of the extra growth rate, 7.6 versus 5.2. Right? And that's what will be playing out in explaining the EVs to EBIT. Now, McDonald's has the highest EV to sales because they have the highest margins. They make the highest margins on their food at 43.5%. That's their operating margin, and after tax, 33.5. So even though they are spending more, because they're spending more at a lower cost of capital, this margin still rules, and that's why people are paying so much of a premium for their sales, $9.54. Where at Yum, they're paying a premium over Starbucks because basically for about the same productivity, higher margin at Yum, 33.5 versus 18.9 at a similar tax rate, people are paying more for sales at Yum than they are at Starbucks. So that's what's happening with the multiples after we do the adjustments. But if you didn't do the adjustments, you wouldn't be able to explain these multiples. And so again, that's what made this assignment slightly more difficult than the previous assignment. And that's what we were talking about in class last Wednesday, because I basically hinted that when the past doesn't give you or the current situation doesn't give you representation of the future into perpetuity, then we have to represent what that perpetuity is. Okay? In a way, it's no different than when McKinsey set up the key value driver formula. Because one of the reasons for KVD this semester in breaking out ROIC as part of KVD, which is not part of a standard perpetuity, is I said that the problem with standard perpetuity is that the perpetuity assumes that the incremental ROIC equals the historical ROIC. When you do cash flow divided by R minus G, There is no difference in ROIC in the future and in the past. When we rearranged it to be key value drivers, we swapped out cash flow for profit and ROIC, and that allowed us to put in a more representative value for the future. The reason why we put in a more representative value for the future is because the future could look different than the current situation. It's no different than what we're looking at the multiples. So if the future looks far different, we have to create what we think that future is. So it's no different than putting in a representative ROIC. And in this case, we're also putting in a representative ROE, right? And unfortunately, we can't just look at today's ROEs to be the perpetuity ROEs. It isn't working out that way in the retail industry right now, particularly in food retail. And same is true for ROIC. So that's why we had to go through this process to kind of build out what we do think it would be in perpetuity, then do the multiple analysis. This is also a challenge you run into with cyclical businesses, because in the down cycle, you might need to adjust the earnings, or in the up cycle, you might need to adjust the earnings, because if you're at the top, the peak or the valley, then it can distort the multiples. And this is just another example of how that would play out, because right now we're in a valley. So that was homework 12. A little bit tougher assignment, but if you had thought it through in a process wise, you could have come up with something closer to this. And assuming you came up with closer to this, that'll be considered when we do the grading.
Could you just show the PE tab again?
Now, again, I don't know if it was in this class, but somebody said when they were doing general dynamics, like one of their peers looked like this. I think it was L3. They were looking at L3 and they were having trouble with the data of L3 today in coming up with a multiple for L3. And what I told the TA to tell that team, so I'll just use that as an example here, is number one, choose a different company. Like I'm not making your lives difficult in the general dynamics presentation. I'm just saying you have to pick from a universe of companies that are in each of those sectors. You don't have to pick the most difficult companies in those sectors and try and do what we just did here for Starbucks, Yum, and McDonald's. Now, if you choose to, if you want to go forward and you picked L3, then you'd have to go through a similar justification process that we did here, and then come up with a multiple and then compare them to general dynamics. So it's a little bit more complicated. It can be done. It was a higher standard. I'm not asking for in your group project. So I would just say pick companies that are easy. So for example, when you do aircraft and parts against general dynamics, I wouldn't pick Boeing. I can tell you right now, Boeing is going to have the same problems that these companies have right now. Matter of fact, Raytheon is probably going to be another company that's going to have a challenge, because Raytheon just went through a gigantic merger with United Technology, and their last year's results look nothing like their future. And Boeing went in the tank last year and looks like these companies. So their multiples are going to be screwed up, right? And I'm not saying we don't do them, but if you want to make your lives easier for the group project, I would just make sure that you pick multiples that are easier to explain. But if you want to be ambitious, you're welcome to try and do so. All right. So again, questions, comments, concerns, crippling fears about anything?
Professor, I had one quick question about the homework.
Yep.
So if we were, like I used like those negative numbers for the ROE, like the average of the four, what would the grading look like for that?
Well, you lose points for not having a reasonable ROE. I have to talk to the TAs about how many points to give you credit for if you're basically giving reasonable explanations on the wrong data. Because I knew that, and I say that just because I know that this was a tougher assignment. Like I intentionally chose an industry that I knew would be tougher. I also, by the way, and I apologize, I was trying to do the same thing with United Airlines with evaluation, and I realized it was actually too tough, because United wasn't balancing the CFI. And to make you guys have to figure out how to balance the CFI at the very end of the semester seemed a little much, especially given this assignment. That's why there was a change on Friday from United to Merck, because I didn't want to add the extra element of trying to figure out how to balance an unbalanced CFI. Because an unbalanced CFI would have been an invalid model. And basically, I think in the class, nobody would have gotten the extra credit. You all got zeros. So that's, by the way, why that switched. But in context, I also recognize this assignment was more difficult. So as long as you followed the process and you at least did some analysis that was consistent, there will probably be a partial credit, right? But you can't get full credit if you had negative ROEs. It's just, again, I want to make sure everybody understands, grading aside, like that just wouldn't make logical sense. So therefore, you couldn't have followed that through. And that's just something in the real world you should always be aware of. Like sometimes you're doing your plugging and chugging, and like I said, you're going to run across anomalies. And when you come across these anomalies, whatever they are, you're going to have to try and deal with them. And so early in your career, you're probably going to be asking a lot of questions about these anomalies. Later in your career, you're going to have a sense of how to deal with these anomalies. But that was the point. I gave you an assignment that had anomalies. And so it's a question of what did you do with the anomaly? So the most important part of this assignment would have been to recognize the anomaly and try to deal with the anomaly. To me, that would be the highest probability of getting the best credit, right? If you just plug the numbers in and said, well, they don't work, but I'm just going to try and do it anyways. Well, that's less of a good answer, right? Because yeah, you might solve it mathematically, but you're kind of solving on an incorrect premise. And at this point in the semester, that's what I want you guys to have recognized.
Hey, Professor,
So,
just a quick follow-up to that. Because the assignment placement is due tonight, and are these going to be graded before tonight, so we know if we need to do that at this point? Or are you going to extend the replacement possibly?
You mean you need more time to do the assignment replacement because
Well,
you
I'm
know
just,
how great this is going to be? I'll tell you, just
yeah, that's what I'm
to be
saying.
fair to TAs, the fact that they had 2 assignments due today, this and the extra credit, there's probably a 0 probability they're going to finish all that grading by tonight. I mean, just that wouldn't be fair to them. So I told them Thursday, not today. So what I would just say for the assignment replacement is if you think you're going to need it, you should have a fairly good idea based on what we did in class today, whether or not you would need it for this assignment. I would just say out of an abundance of caution, do the 500 words. Can't hurt
Okay,
you.
thank you.
That's what I would do. If I were you, I would just do the 500 words because it can't hurt you at this point. It's a really easy assignment for the assignment replacement. And then just have that, if nothing else, in your back pocket, because it may not be this one, it might be something else, but as they're applying the criteria, it's in your best interest for them to basically have an annulment for one of the things that didn't go well for you if you're trying to get the best grade. Other
Professor,
questions? Yeah.
I have a question about the project.
Mhm.
So last week you said that we were just doing GD in 5 competitors, and now I think it switched to 6 competitors and 2.
I think I made a mistake when I said 5. I should have said 6.
Okay,
2
so
in each
will
segment.
we be collecting all new data then if our team like started it and had 5, but now we need 6?
No, not necessarily, because what you need, and I'll go back to GD here. RV. So as I said, what you need is, 2 of them should be on this list. So
Okay,
it's going to be GD against these 2. So if you already have 5 and 2 of them are on this list, you don't have to recollect that data. You can just use the 2 that you had.
okay.
It's
So
the
it's
same thing.
okay that like for some they may have been collected on one day, and then for some the data is collected from a different day.
I mean, as long as in the segments, as long as the stock prices didn't change that much, if
Okay.
you're a day off, I don't think it's going to matter.
Okay,
Now, if the
And-
stock prices did change, I'd say, unfortunately, you probably have to redo the data.
okay. And also, do you want like our Bloomberg screenshots in our presentation or only pictures of our like multiple analysis Excel documents?
For purposes of your presentation, what I really want is just the screens from Excel.
Okay.
So that's, and I'm going to trust that the data that you give me is accurate
Okay. Sounds good.
for
Thank
this
you.
project.
Thank you.
I mean, at this point, like I said, I think everybody knows how to get the data, and to some degree, you're all doing the same data. So I'll kind of know if you have an outlier because everybody's doing the same data. And out of 23 companies, if 23 companies have one number and your number is far different than something else, it's going to stick out.
Okay, that makes sense. Thank you.
Sure. But good questions. Other questions? All right. So last but not least, I know you're getting harassed about this week. Please do the online course evaluation. We always appreciate that feedback. So do that before you run off to your jobs or whatever you're doing. And then finally, for those of you that are juniors, I just wanted to give a quick heads up. As you know, we are going in the fall back to live classes for the first time in a year and a half, which will probably be a different experience. A 443, just kind of re-going through this again. But I am going to be looking for TAs to go do the live classes in the fall. So if anybody is interested in the TA application, that's going to be made available this week. And please feel free to apply. The main criteria for being a TA is that you need to have an A in the class, A minus or better in terms of grade. And it pays $12 an hour. But long story short, I am looking for some TAs in the fall. So if you're interested in applying, please apply in that link. If you have any questions, please reach out. Otherwise, I'm going to give you the balance of time today to talk to your teams and finish up on your GD presentation, or for that person that needs to write the 500 words to work on your assignment replacement. So otherwise, look forward to hearing what you guys had to say about GD on Wednesday. We'll start our presentations right at 11. Got to go through all five teams or 6 teams. And that'll be pretty much our last day of class. So without any other further questions, I'll see everybody on Wednesday. Have a good week.
Professor, can you stay back at the end? I just have a question I wanted to ask you.
Sure.